Let's talk to Tim Gregory. He's the Chief Investment Manager for Vermeer Investment Management and a very good friend of mine. Very good morning to you. Right, great British pound, not so great. Trade wars, looks as if everything's calming down. FTSE rallying 1,000 points in a matter of weeks. Extraordinary price action. Is this the most exciting time to be an investment manager? Can you remember more going on and extraordinary?
Well, there's always loads going on, to be honest, Nick. I mean, so, this is nothing particularly new. We've lived through, much more volatile times than these. But has been a great rally for the FTSE 100. What we know is that the FTSE 100 is not particularly a reflection of the UK economy. It's quite often more a reflection of what the pound is doing.
Yep.
And the pound has been weak because interest rates finally did not go up, as
predicted
discussed,
by you.
And may not go up for some while. And pound has retraced quite a long way. And of course, that has been coupled with a strong rally in the dollar. So the fall in the pound has been exacerbated. And that, of course, is extremely good news for those major components of the FTSE 100 that benefit significantly from a weaker pound.
Yep.
So, what makes up the FTSE 100 is not so much about the UK economy, it's more about what the currency is doing. So we can recall, can't we, when we came and had the Brexit vote, where Britain voted to go out, the pound collapsed.
FTSE
and
shot up.
Instead of going down, like everyone expected, because what makes up the FTSE 100 is so dominated by international companies that happen to be domiciled in the UK, it's more about that. Of course, the other thing that has helped the FTSE 100 is the mega cap oils like BP and Shell are also a very big component of the FTSE 100 as well.
Yeah.
So their rally, much to everyone's surprise, because the oil price has gone up a lot and they've delivered good results, has also really helped the FTSE. So the FTSE, having been the laggard and everyone hated UK equities because the pound was going up and the economy was struggling, actually now has done really well. And global markets have been helped in the last few days, haven't they, by the
calming of tensions.
Exactly. Good way to put it. The cessation of the worst fears at this time of where trade negotiations might lead. So whether that can has been just kicked down the road and we'll all set off again in a more difficult way later, we will see. But at the moment, that's helped global markets rally. The S&P 500 has probably made its way a little bit more than halfway back up from the year's lows, but is still 4 or 5% below the highs we saw in January. And we still are of the view that although the news has clearly been better,
yep,
and obviously very good news for the UK stock market in the form of the weakness of the pound, which is helping our exporters and helping our international companies, it's going to be a struggle to get out of the higher end of the range for the market as a whole.
Yep.
And obviously US markets are globally 60-odd% of the benchmark, whereas the UK is 6% of the benchmark. So much more significant than what the US market is doing for global equities as a whole.
Okay, so interest rates are not going up anytime soon in the UK, except petrol is now going to cost me £1.30 a litre, there or thereabouts, they're predicting. That's going to hit me in the high street. Marks and Spencer's closing shops, retail in trouble, okay. Are we that far away from a recession with slowing housing, etc., etc.?
Well, there are a number of really difficult factors because, as you say, the high street has been struggling for some time, and that is a combination of, the Amazon effect, which has impacted, a lot of consumers. And if the oil price rises, and that creates an inflationary effect, and if there's some wage pressure as well, these price pressures have to be absorbed by retailers who are struggling to stay competitive, and therefore it's very hard for them just to pass that on to consumers. So that puts pressure on margins, so there's a risk of store closures, as you say, and that just creates a continued vicious cycle for areas like the high street. So that is a real problem for UK at the moment.
So in terms of the breadth in the US, in terms of the indices themselves, we've clearly got a few leaders, but the breadth indicators are not very good at the moment. Okay, they're basically saying that the markets have not recovered from where they were when they were going bananas in January. Do you think there's any chance of some sort of crash this summer?
Well, I mean, you can never say never, because something very nasty can always come from left field that is completely unexpected and create something like that. But I see every reason to expect markets to continue to be in this channel, able to find support at the lower levels and struggling. You know, when we got to 28.70, valuations looked very stretched. The results season that we've just had was good. There are some signs of inflationary pressures in wages. Certainly some pockets of industry are seeing labour shortages in the US. 10-year bond yields have now crept a little above 3, but actually bank stocks, which you might have expected to do better, and we certainly thought that would do better in that environment, have rather stalled. To your point about sector focus narrowing, the market continues to really support the things it likes. And of course, bond yields being weak and there being some inflation pressures from fuel costs and freight prices. So we saw a company like Campbell Soups have very difficult results at the back end of last week because they're struggling with price and they have some cost inflation. So those parts of the market, which for a long time when bond yields were always suppressed, you know, those staple type businesses are having quite a tough time of it actually at the moment.
Okay, so my last question, huge amounts of M&A.
Yeah.
How do you pick an M&A target as an investment manager?
Well, we don't try to invest in a company because it's going to be an M&A target in general. What clearly you can see is certain industries are at any given time subject of a greater degree of consolidation. You're probably seeing that globally now with all that's going on in the media industry.
Yeah.
You know, there's a lot of change, and because of the impact of Netflix, a lot of companies are trying to figure out how to position themselves. So we prefer to try and invest in high quality companies, generally speaking, or you know, where it's a restructuring story because new management's gone in. You know, so one end of the spectrum is to continue to invest in high quality growth. There are restructuring stories that are quite often attractive as well. To be honest with you, M&A activity for our portfolio is a bonus, not an expectation, to be honest.
So you wouldn't go out and go, do you know what, I think ITV may be bid for this year, therefore I should have a position in that. You've got to work out the fundamentals first and say this is a proper stock, and these are the reasons. The PE's below 10, and it's in the right.
Well, we own ITV, small position on our portfolio, has new management, valuation is, we think, attractive. Cash flows are still strong. There are clear and well-known problems for linear TV that it's been struggling, but we think it continues to be a relevant medium with the right content. We think ITV's got good content. So if it were part of the global consolidation within media, that wouldn't be the biggest surprise, but it's not why we own it.
Right. And finally, dogs, bad sectors. What is there anything there at the moment you think, do you know what, I really don't like that, I really don't understand it?
Well, as I said earlier, you know, the sector that's probably had the biggest swing from being in favour for a long time to out of favour. Well, I was really going to say consumer staples actually, where, you know, less so in the UK because the pound has weakened. But globally, if you look at the share prices of things like Procter & Gamble, I mentioned Campbell Soups, Colgate Palmolive, which has, you know, been a great company over the years, fantastic market positions, great cash flow, a really good company. But it's struggling to grow its top line in the way that it has in the past. And bond yields rising have put these stocks out of favour. So the big question for investment in those sorts is, if you think what we're seeing in the bond market is a temporary phenomena and we will return because of huge global debt levels, we'll return to the low growth, low inflation environment, and bond yields having spiked up, ultimately subside away again, these stocks will probably come back into favour. That probably is not the story of right now in the way people are thinking about markets.
Question. Well, I'm finally going to say I read in, I think it was the Sunday Times, there was a pundit suggesting that the FTSE was the cheapest since the Second World War, still because of the all-share dividend yield to the gilts, and that differential says the market is cheap. I can't believe I'm saying that.
Well, that is a very fair point. The simple fact of the matter is, because of the large yields that you get from BP and Shell and Glaxo and Vodafone and companies like that, and the weighting that they have in the FTSE 100, that creates a very decent level of yield on the market as a whole. It's concentrated in quite a small number of stocks. What actually makes up for that but some high quality companies within that as well. And, you know, you can add in Unilever yielding over 3%, for example, as well. So, and the fact is 10-year gilts yield 1.5%. In the US, 10-year government bonds yield over 3%, and the S&P 500 yields just over 2%. So that is a very big difference.
Yep.
And on that basis, that's a very fair point that UK equities are cheap.
Tim, on that note, we run out of time. Thought-provoking as always. Thank you very much indeed.
Thanks very much.